Dividend relevance theory is a financial theory that suggests the firm's dividend policy does not affect the value of the firm and is therefore relevant to investors. This is contrary to the dividend irrelevance theory proposed by Modigliani and Miller, which argues that dividends have no impact on firm value in perfect capital market. Key dividend relevance theories: Walter model and Gordon's model. In these slides, we will looking at the investor preferences and the implications for dividend relevance theory. Walter model argues that dividend policy is relevant based on the relationship between the return on investment and the cost of capital. Investor preferences. Investors prefer low dividend because retained earnings can be reinvested at a higher return. Investors prefer high dividend because reinvestment does not yield much value, or the dividend policy may be neutral. So these are the three preferences. The implication is a firm should retain earnings if it can earn more than what the shareholders could earn on their own. That means the company can reinvest their profit in any other project or any investment, so that the company can earn more profit. It will automatically increase the company's market value in the stock market. Because of the company's market news will impact the stock price, and if the company's consistent profit will also reflect in the stock market price. If the company earnings goes up, means it will also reflect in the stock market price. So if it is so, a firm should retain earnings if it can earn more than what the shareholders could earn on their own, according to Walter's model. Then we move to the Gordon's model. This theory is based on the idea that investors prefer the certainty of dividend over potential future capital gain. It is summarized as by the bird in the hand argument. In this Gordon model, investor preferences are: dividends reduce uncertainty. Investors perceive firms paying regular dividend as less risky. Firms that pay higher dividend can have higher market value due to lower perceived risk. That is the implication of Gordon model. Apart from this, the general investor preferences under dividend relevance: risk-averse investors prefer regular stable dividend because they don't want to take the risk, and high-income investors might prefer capital gains to defer tax. Okay. Then institutional investors, for example companies, mutual fund companies, banks and all, they often seek steady dividend paying firms. Implications for corporate policies: companies must evaluate their growth opportunities before deciding dividend payout. Firms in mature industries with limited growth should consider high dividend payout. Firms in high growth sector should retain profit for reinvestment. Dividend policy affect investor perception, stock price stability and marketability. So in this video we understood that the investors' preferences and the implications in dividend relevance theory. So whether the company decides to distribute the profit or not, in general it's up to the shareholders. If the company's market value increases because of the dividend decision, means that will be good for the companies and as well as for the shareholders. Thank you.